Welcome to the Risk Manager's Corner. Today we're opening the lid on general insurance, also known as property and casualty insurance, and looking at what can go wrong inside these supposedly simple products. We'll cover underwriting, reserving, claims, and the control mechanisms you need in place to keep your P&C portfolio stable. What general insurance covers. General insurance protects against physical damage and legal liability. It includes auto insurance, home insurance, commercial property, public liability, and professional indemnity. Policies are short-term, usually 12 months. Payouts are based on actual loss. There's no fixed benefit. If there's no loss, there's no payout. Underwriting risk. This is the risk that premiums are set too low for the actual exposure. Maybe the insurer underestimates risk in a flood-prone zone, or fails to factor in rising repair costs, or accepts too many high-risk clients without appropriate premium loading. Adverse selection can also creep in, when higher-risk customers are more likely to buy the product, but pricing doesn't reflect it. Underwriting risk eats into capital fast. It's often a silent killer until losses start rolling in. Reserving risk. Once policies are sold and claims are underway, reserves must be held. That includes both reported claims and those incurred but not reported, IBNR. If the reserves are set too low because of bad models, long-tail liabilities, or unexpected legal developments, there's a hidden gap, and when it surfaces, it hits capital and earnings like a brick. Claims management risk. You can underwrite well and reserve perfectly, but still lose money through poor claims management. This includes fraud, inefficient or manual workflows, overpayments, delays that escalate legal costs, strong triage processes, experienced adjusters, and automated fraud checks are critical to protect the claims function. Defining risk appetite. Every insurer must define its risk appetite clearly. That includes maximum policy exposure per line, regional and sector caps, limits on broker commissions, triggers for escalation when things exceed thresholds. Without this, underwriting drift is inevitable, especially in competitive markets. Risk identification and mitigation. Risk teams should regularly run loss ratio monitoring, broker performance reviews, scenario testing, catastrophe exposure reviews, audits of underwriting files. This is how you stay ahead of the curve, not just reacting, but detecting. Minimum risk standards. Your control framework must include underwriting authority matrices, quarterly reserve reviews, regional exposure caps, claims escalation protocols, stress testing for extreme events. These aren't regulatory checkboxes. They're what prevent risk from compounding unnoticed. General insurance may seem basic, but it hides frequency risk, claims volatility, fraud exposure, and portfolio creep. Your job is to put structure around it. Test assumptions. Review exposures. Challenge the business with data. In the next episode, we move into life insurance and tackle mortality, longevity, and persistency risk head-on. Make sure you're subscribed, and I'll see you in the next one.